Hello and welcome back to Beyond Moon, everybody. Today's episode 4, and we're going to be talking about accumulation and preservation. I'm, of course, joined by my good friend and colleague, Mr. Cryptopolis. Say hi, Dave.
Hey, Jerry, how you doing? How's everybody doing?
All right. So we're going to cover some incredibly in-depth topics today. This is really about expanding one's financial literacy. Today, I'm really going to be a participant in this as much as a presenter and really lean on Dave's strengths as it pertains to the information base in this particular episode. So you guys can join me in picking Dave's brain on how some of these principles can help us going forward in the future as it pertains to dealing with capital. So let's take it away with, hey, Dave, let's get into this understanding value. I think that'd be a good starting point. What do you think?
Sounds good to me. So when we think about value, what we want to try to do is buy something that the market perceives as being, not as valuable in current terms than it could be in the future. So something that would be undervalued. And so you don't want to be the guy who pays the top price for everything, right? You don't want to buy gold at 2,000. You don't want to buy, stocks at 30,000. Where they've been. And hey, we've got a little bit of a pullback in the market, almost 1,000 points as we're speaking here today. And so you want to try to evaluate stocks or any asset that you want to invest in terms of its intrinsic value. So there's a lot of different formulas that you can use, but we're going to keep it real simple. I don't invest in anything. This is just personally me. This is not investment advice that doesn't pay me to own it. And so when I invest in something, or it's speculative. So I divide my portfolio into a percentage that is speculative, and then I invest in other assets that pay me to own them. And so the value that I'm trying to extract from my investments is either income or a high potential for capital appreciation. So when we think about this understanding of value, there's a lot of the macro environment, right, that fits into this. There's inflation, there's deflation, and then there's strategies that you can use to hedge your position so that you don't lose that value over time of the ones that you've invested in. Now, we've had nothing but really inflation. We've had an average inflation rate of 2 to 3% for the last 80 years, 90 years almost. And so when you think about it, if you have a 2% to 3% inflation rate over a long period of time, that means that the dollar purchasing value, the value of the dollar, especially the US dollar if you're in the US, has decreased over that period of time. So for example, you probably heard your grandparents or your parents talk about the fact that they used to go to the movies back in the 1920s or 30s, and it only cost them a penny or a nickel. Well, today you take your kids to the movies and it's 15, 20 bucks a ticket. And so you've got it's inflation. That's all it is. Now, we haven't had deflation except during recessions and depressions. We had a little bit of a deflation back in 2008, 2009 during the financial crisis. The biggest depression or the biggest deflation that we had was back in the 1940s, but we also had it in the 1929 to 1936 period during the Depression. At that time, prices declined dramatically, which meant that the dollars that you had in your pocket could go a long way to buying things. The only problem is wages deflated as well as prices. And so a lot of people's wages came down to like nearly nothing. So there was a balance there between wages declining and prices of everything declining. So you really had the same purchasing power, but now everybody felt a little less wealthy because they weren't making as much money, even though their money went a little bit further. So but there's lots of things that you can do. Now, we've had a long period of inflation. A lot of people are saying now that we're going to go into another recession. The stock market has been up now since 2009, March of 2009. We've had one of the largest expansions of the economy that we've ever had. But we've had declining interest rates. And so we saw actually last Friday that the 30-year US Treasury bond in the US had fallen below 2%. And I believe today it's like at 1.84%, which is the lowest level in 100 years.
Right.
With those kinds, and we also have other countries. So we have Denmark, Norway, Sweden, Japan. A lot of countries are either at zero or negative interest rates. To me, that signals a deflationary environment. And so, but there's a lot of things that you can do to hedge that. In a deflationary environment, typically the prices of all assets come down. One of the reasons why we're invested in crypto is because there is a stable number of cryptocurrencies, mostly, and all of the tokens that are available on the market today. And so, for example, Bitcoin has 21 million maximum supply. XRP has 100 billion maximum supply. So the XRP ledger, for example, can't print more XRP. There's only 100 billion available forever. And not only that, but it's slightly deflationary in the number of tokens that are available because every transaction burns a small amount of the XRP token. When that's the case, you've got a deflationary asset, okay, in an inflationary environment, especially because the Federal Reserve is printing more money. The problem is, of course, is the Federal Reserve has to continue to print money because they want to meet their inflation targets, which they're not meeting, by the way. They keep printing money, but they can't get to that 2% target rate that they're interested in hitting. Instead, we've constantly been under that. No matter, they keep printing money, and we keep getting lower and lower inflation rates, which means that they're going to have to print a lot of money in order to get that, to keep that inflation rate higher. So we hold XRP, we hold other cryptocurrencies because of that fixed supply. And when we have a fixed supply against an inflating asset, the only thing that the token that we hold in cryptocurrency, and this is one of the reasons why we hold cryptocurrency, is it maintains its value relative to that currency that's being inflated. And I mean, that's our hedge. That's our hedge against whatever comes in the market, whether we get hyperinflation, so prices and assets go through the roof, or we get deflation, which I think is a more likely scenario. We still have a very stable supply, a hedge against traditional markets doing something erratic.
Well, this is exactly the principle since, I guess, 1971, when we went off the gold standard, that gold became a hedge against inflation, not because it had a fixed supply, but it had a very tight percentage of increase into the supply on a yearly basis that could be easily forecasted. Am I correct in that? Yeah, okay. And so cryptos are really starting to take a lot of that same principle, but only now in a digital form as opposed to the actual physical form of a precious metal.
Right.
Right. No, this is a good thing. You know, forever, and I'll tell you, when I first started learning about crypto, I had heard the term inflation, and I knew that the government had a mandate, or i.e. the Fed had a mandate, that they wanted to see inflation. And for a long time, I just took it for granted that that was a good thing. And I didn't really understand the mechanism behind it until I started learning about, getting some financial literacy and understanding that when the printing presses are rolling, what they're doing is they're adding dollars into the circulating supply, devaluing slightly every dollar that preceded it.
Right.
And it wasn't until I understood that mechanism that all this purchasing power dynamic started to come into play, that, that the picture started to get clearer for me. Now, I guess
Exactly. So if you have, let's say, for example, you have a Babe Ruth card, a baseball card from the 1920s, right? You've got a very rare item there. And I looked into this years ago, and it's worth a lot of money. If you have an original Babe Ruth card, his rookie card, I mean, it's worth millions of dollars, I believe. I haven't looked up the current value, but it's worth a lot of money. But what if someone found in an attic someplace thousands of them? So all of a sudden, the single Babe Ruth card that you had that was worth millions, now there's thousands in the supply. All of a sudden, that value has got to come down, right? Because the supply is so large. So it's really just supply and demand. And when the Fed, you've got $1 in your pocket and the Fed starts printing so many of them that there's more supply out there, that there's only in the dollar that you have in your wallet now is worth much, much less because there's too many out there. Now, the Fed would argue that the only reason that they're printing them is because of demand. They say there's a demand for US dollars, and that is true because most debt in the United States is, and all across the world, is denominated in USD. And so they need those USDs in order to pay down debt. The problem with that, of course, is that debt is also the majority of the money in the world. The Federal Reserve System and the reserve system of banks means that they only have to hold about 10% in cash, in actual USD, and 90% is in debt to either small businesses or consumers or wherever it's going to go. And so everybody needs that USD to pay down that 90% debt. That's why they have to keep printing. So they can't stop. They're going to have to continue to print. And that debt is never going to go away. A lot of it could default, of course, and get wiped off the books. But in order to maintain the value of that debt, they have to print more money. And that continually decreases the purchasing power of the US dollar.
Right. So what this tells me, right? So some of the, like, what can I take from this information that would be practical, right? And that is, it goes against the teachings of my grandmother and my mother, who were firm believers in holding cash,
right?
Having cash. They believed that was a very it was risk-free.
Right.
And now we have this dynamic in play where, with a very large degree of certainty, we can say that the Fed has to keep printing dollars. They have to keep devaluing each individual dollar that's already in circulation. So therefore, holding cash is risky.
Right. So what is the risk to the Federal Reserve if they don't print more money? See, that's the real question.
Is collapse, right?
What's going to happen? The value of the dollars that we currently have is going to increase in value because all of the debt, like we mentioned, is
the demand of the other countries, right? But
so people are going to, now you got a supply and demand issue. If there's more demand than the supply because they stop printing money, that means that people are going to have to bid up to buy those US dollars because they need them to pay their debts. And so if the supply is, they cut off the supply, they don't print any more USD, the existing supply becomes more valuable,
right,
which is going to raise interest rates. Interest rates will go through the roof.
And now let me answer this. You tell me if I'm wrong. Yes. All right. This is where I go, teacher. I think I know the answer, right?
Okay.
When rates get higher, because of the dynamic that you just explained, now what happens is the ability to pay off existing debt and the threat of defaults rise exponentially. And we have this monster. There's a lot of different kinds of debt, but just this is the one I'm thinking about right now: corporate debt. You have all these billions upon billions of dollars in corporate debt that when the rates go up and their ability to pay them diminishes, you start getting the spread in the market and getting downgraded, getting your credit worthiness downgraded. And it's like the US debt as a nation, not a big deal because they just keep printing money. Corporations can't keep printing money as rates go up because people won't buy their bonds.
Well, that's exactly right. But you said that if they keep printing money, but in our scenario, if they stop printing money, then what happens is those dollars become more valuable. People will have to bid for them in order to get the USD that they need in order to pay their debt. But what happens to the bonds? See, if they don't print money, demand increases, the dollar value goes up, interest rates go up, and what happens in the relationship between the bond value? So even the US government is going to be in serious trouble if they stop printing money and the demand for dollars go up and the interest rates go up, because what will happen is they'll send their portfolio of 30-year treasury bonds that they're in the market buying every single day downward. See, there's an inverse relationship between the interest rate and the bond. So as bonds decrease in value, the interest rates go higher. And so they're sitting on trillions of dollars in 30-year treasury bonds. And if those values go down, their balance sheet is losing trillions and billions of dollars. They have to keep interest rates low. If they keep interest rates low, that means bonds rise and they make money.
So Dave, so the same principle that I was explaining with corporate bonds
exactly,
and the associated risks for servicing the debt actually does apply to the US, if I heard you correctly, because what you're saying is, although the US government is not a corporation and does not have shareholders, it does have bonds. And if other countries lose confidence in that, they won't buy the bonds.
That's right. Well, what happens is
exactly, their operation goes down.
That's right. So the value of their bonds decrease, and they're saying, okay, well, if interest rates are going up, I've got a bond that's paying me 1.8%. And if the bonds start to decline, they're holding a deflation, an asset that is declining in value. They might want to sell those bonds in order to put them in short-term bonds because short-term rates are going higher. Maybe they can get 2% on a 3-month. Why are they holding a 30-year for 1.8? So if this is in our scenario that the U.S. government stops printing money, all of the value of the existing dollars become more valuable, and interest rates rise. And so when the 30-year bondholder sees that they can get a 2-month for 2 or 3%, well, they're going to jump out of their 30-year and they're going to go into the short term.
If there's a buyer for the 30-year,
if there's a buyer, exactly. So they're going to be dumping them on the market, which will invert the yield curve even further than it already has.
You know what? And it's real. This is an interesting dynamic, and it's actually unique to the United States. No other country is in this position. And that is because so much of the global debt, whether it be other sovereign nations or other corporations, is in the US dollar, it presents a completely different paradigm for the ECU, the European Central Bank, or the Monetary Authority of Kuwait, these other central banks that, you know what I mean? Because their currency is just now going into hyperinflation.
Well, I'm not sure about Kuwait, but on the ECB.
Well, I mean, any other country that isn't the world's reserve currency is
Right.
not going to be in the same position as the United States with a supply and demand, or the demand for their currency.
Right, but see, they know they know that when their particular currency is not the world reserve currency. Most of the debt in their own country is denominated in USD, so they have to sell their local currency in order to buy USD, right? And that's
Yeah,
why
but
that's
wouldn't
why
that devalue their currency, Dave?
that's why they have to they devalue their currency so that they can get better trade deals. But when they devalue their currency, they also have the same issue because locally, all their debt, their locally denominated debt, is running into the same issue that the USD debt is doing across the world, and that is if interest rates rise, they're going to have a lot of defaults on their local debt. So they are in the same situation that the the United States is, except on a local level.
Now let's
On a
bring
more
this
limited
down to the
scale.
consumer, to Joe Plumber for a minute, because these are pretty, these are high level thinking things, and for a lot of folks might
Sure.
not impact their day to day. However, if you are a normal average citizen consumer and you have personal debt and your debt isn't structured contractually with a fixed repayment, all these events that we just talked about could absolutely affect you. And isn't that one of the things we saw that helped create a lot of the 2008, once the fixed rate options of these mortgages turned
Oh,
into
right.
variable rates based off of the market, then the shit hit the fan.
That's absolutely right. So any variable rate mortgage, especially in this environment, could go, higher, and you get a reset that you can't afford anymore, and that will cause a lot of problems with the average Joe Plumber, as you mentioned.
Well, yeah, and
So
then also the stuff with credit cards.
right.
I think
Well,
right
yeah,
there.
that's the same thing. If you've got a lot of credit card debt, if you have a lot of personal loans, if you have a mortgage that can be reset, all of these things are going to be impacted by interest rates. Now, it's probable that, as we mentioned, the Federal Reserve will continue to print money on a massive scale in order to keep those interest rates low, because it's in their best interest to do so. So the danger for the average person who has debt is actually minimal at this point, because the current debt that they have is probably going to be a lot less in the future because of the devaluation of the dollar. And so, debt is not necessarily a bad thing if you're using it for a business purpose, because you can write those off, you can write off the interest expense, you can, and so it's not too bad. As a consumer, though, yeah, debt is very, very bad. You want to try to get rid of debt as much as you possibly can. But for businesses, as long as interest rates stay low, like we said, it's a good thing. Now, the average person, if they don't pay off their debts, and we get into a deflationary scenario, in a deflationary recession, that's going to impact wages. And when
Right.
that happens, then the consumer, the average Joe Plumber, the John electrician, is going to be in really tough shape, because his wages will probably decline, making less cash flow on a personal basis available to pay that debt.
Which is the same principle we talked about with corporates and their ability to service their debt. The
Exactly.
individual's ability to service their existing debt is going to be impacted, and therefore the risk starts growing
That's
exponentially.
right. But there's also a risk of holding cash, right? Because if there is a lot of inflation, if the Federal Reserve continues to print money like we think they will, in order to keep those interest rates low, well, the dollar that you have in your pocket right now is going to be worth less in a year. And if they do really start cranking up, and we have some evidence to consider and think that they are going to really start to crank up the printing press at the Fed, it may be every 6 months that you're going to have a major deflationary event with the US dollar. And so now, instead of waiting a year where it deflates 2%, it might deflate 2% in 6 months. So that there's also a great deal of danger in holding cash. So, boy, it's a really tough situation. And I'm sorry?
You mean the U.S. dollar, the currency supply inflating more?
That's right. That's right.
I thought I heard you say deflating.
Oh, no. I'm sorry. Inflating.
Yeah.
If I said deflating, not
No.
inflating.
I mean, I'm following. I'm hanging on every word, man.
Okay.
I'm right here.
The only solution for the average person, in my opinion, what I'm doing is I'm holding cryptocurrency. I'm trying to hold an asset that will likely maintain its value if the pair, the currency pair, really, if you think of XRP USD, it's a currency pair.
Right.
If you've got one that's inflating, that's printing more, that is devalued, the other one has to go up. There's no end if or buts about it. If you're holding gold against USD, gold has got to go up if there's a limited and fixed supply. The only variable that can change that with gold versus XRP is gold can be mined. They could discover a new, extremely large vein. You don't know what can impact the price of gold. You could have, if we do go into a recession, lots of gold. In fact, I think it's a majority of, I don't know, I'm not an expert on gold, but this is just something that I've heard Mike Maloney talk about, is that a lot of the gold that is mined is used in jewelry. Now, if we get into a recession, a lot of purchases of jewelry, especially of gold jewelry, will decline most likely. The big buyers of gold, and especially gold bullion, have been central banks around the world.
Right, nation states.
Yeah.
Right.
So that's what's been driving the prices a little bit higher.
So this, I believe this is correct. I want to run it by you, make sure that I'm completely on track here. So gold, cryptocurrencies, hedge, got it. This is a principle or a dynamic I want to run by you, make sure that I've got this correctly. So my single XRP, which I know there's only going to be 100 billion of them, today is at 27 something cents. If demand did not increase, and the supply obviously will not increase, but the value of the US dollar goes down, then the value of my XRP goes up.
Yes, as long as that, let's say demand for XRP remains stagnant,
or
where it currently is, right? And we have more inflation in the US dollar. It has to, simply by supply and demand basics, increase in value versus the asset that it's paired with that is inflationary.
So assets that have scarcity and have a demand in the marketplace are good places to put your money in times such as these.
Exactly. And there's not a lot of places, there's not a lot of assets that act like that.
Diamonds, gold, silver.
They're all mineable though. So in fact, even diamonds, I was reading a news story the other day that they have improved the technique of manufacturing diamonds to specifications that are almost indistinguishable from actual mined diamonds. In fact, many companies are now preferring that because there's no conflict. There's no the conflict diamond. There's no
blood diamonds, no 25 people lost their lives, so this guy could have his necklace.
Exactly. So all of these other assets, the diamonds, silver, and gold, can be mined. They can find a big haul. They could, silver is more used in industrial applications. Gold is also used in industrial applications as well. But if we are heading into a recession, and the number one driver of the economy is the consumer, and because they have the perception that we're going into a recession, like the Dow is down 1,000 points today. If they start to pull back on their spending, and
Right.
as we know, there's some issues with this contagion in China, and now it's spreading to Italy and other countries. People, if they pull back on their purchasing, that will further accelerate a recessionary environment for really the globe, not just the
Well,
United
here's a spin I'd like to add to that. And it's completely independent from what's going on with the virus that's got a lot of people shook. It's completely independent on the inflationary element of the economy, and that is that the population, the world, but specifically the United States, with the baby boomers averaging 65 years old this year,
Yeah.
and the retirement habits of people are completely different than when they're out there in the workforce making money.
Yes,
So
absolutely.
I think we have I think there's a lot to this, and I think, even without the virus that's got the market shook and a lot of people shook because of the supply chain disruptions and the flow of normal business,
Right.
there's a couple things in play. Now, from what I understand, a recession, technically, definition is quarter over quarter decline over 3 quarters.
Well, if you listen to
That
the
correct?
government, yeah, but that's a very much of a lagging indicator. So by the time recession is actually official, it's already been probably baked, and it already started 6 months to a year prior.
And that's my
Uh,
point. I believe
yeah,
we are in a recession, and it's
yeah, I think we are too. I think we
technically,
started to see that, absolutely. In
yeah,
fact, I think we started to see it nearly 9 months ago.
right.
Yep. When, especially last September, when the repo market hit 10% overnight. And so when the Federal Reserve had to step in at that point, they started the new QE, although they don't call it QE. They call it, they said, no, this is just a technical adjustment. Well, whatever you call it, they started printing money again. And they haven't stopped. In fact, they said it was going to end in October. They said it was going to end in November. They pushed it out to January, then April, and now they say it's a permanent facility.
Yeah. I mean,
So it's not going to stop. So I think we started last year, and we're just starting to see the effects. The market is also a lagging indicator,
right.
and so we're just starting to see maybe the effects of that recession start now.
Well, there is a lot to think about in that little segment that we just went through. Um, let's let's jump into a little bit about and dive into this topic of diversification, risk versus reward. Um, I'll state, everybody knows from the last episode where I'm at. I took a position to basically put all my eggs in the XRP basket. I will either be fabulously, the history books will say, hey, Jerry was smart as hell, crushed it, hit a grand slam, and life is great. Or I'll be another statistic that's somebody that rolled the dice on something that he firmly believed in and it didn't pan out. That is not diversification. That is a very aggressive accumulation strategy, one that if you go down that path, you better be able to live with the consequences, in other words, because if it goes to zero or you lose your stuff, you've got nothing. Now, we talked briefly about this, wave of retirees who have to take a completely different strategy, one towards diversification where they are using hedges, where they're, and Dave, I'd love you to jump in here and give us everything you can give us on diversification, risk versus reward, etc.
Well, there's a lot of particularly in the retirement community. So you've got people who are retiring now. A few years ago, I looked at the statistics, and there were approximately 10,000 people a day retiring. Okay. I thought it would have an earlier effect on the market because people are withdrawing from their 401ks, their legacy pension plans, and things like that. It hasn't really done anything to the market because the Fed has really overridden that by printing so much money.
Real quick point on that. Let me ask you if I'm correct. The Fed printing money, and with rates really low, making it very easy to borrow money. The corporate strategy of borrowing low interest rate money and being able to deduct the interest that they pay on it has given them capital to buy their own stock back, which inflates their stock price, which makes the market look like it's doing great.
Well, that is actually a real, yeah, that is right to the heart of the matter. All of the money printing that the Fed has done. Yes, absolutely.
Okay, I'd like a pat on the back from my mentor, my teacher, when I get it right. Thank you.
Yes, it was very, very good.
Okay,
You're absolutely 100% correct that the money that's been printed has gone to corporations in order to float a bond that has, and they've used that cash in order to buy back their own stock. I recognize this as a failure of the corporate governance and policy making in the corporations years ago, in the fact that they could not find, this is really important, they could not find a better use for their borrowed money and their capital than put it into their own stock and buy back those stocks instead of R&D, instead of expanding their infrastructure, instead of capital improvements. And so they said, no, the best ROI is going to be putting it into our own stock. And I said, okay, this market's going to go to the moon. I said, if that's the bet, if that's the only place they could find that would give them the return on their investment, the best return on their investment, the highest and best use of their investment money, then the market's going to go a lot higher. Now, I think we've gotten to the point where, and I'm not sure, because this could be a temporary pullback in the market that we're seeing today, and we could continue to go higher. But that's going to be very, very dependent upon the liquidity in the market. One of the big issues of 2008, 2009, and the reason why the market dropped so quickly was we could not get the liquidity that we needed. A lot of the companies that own the CDOs, the collateralized debt obligations of these mortgages that were sold to corporations and businesses all over the country and investors, was the fact that there was no buyers for them. There's no bids. So they tried to liquidate them. They could not find a buyer or a bid. I won't get off on the tangent that if they were tokenized, maybe they would have found some buyers. But anyway, we won't.
That's a topic for another show, folks. Stay tuned.
That's a topic for another show, yes. So when we see corporations do this, it means that they don't have any other place to invest. They don't think their outlook for the economy is so poor that the only place they could find it was to put it into their own stock, which means that almost all of the money that was printed did not go to Main Street people like you and me.
Right.
It stayed inside the financial system. And that's the only place that benefited from the Fed's printing of money over the last 10 years. It didn't benefit us any. And so now at this point, if you're talking about diversification, the only place to diversify is either you go into financial assets now, which is probably not the greatest idea because we are at all-time highs, or you diversify into crypto assets or other physical assets. Now, in a deflationary recession, though, almost every asset declines in value, from gold to silver to everything else. Now, I'll ask you a question and see how well you are financially literate here. Just putting you on the spot.
I'm ready to go, man. And this is there's no script. We're flying. We're improv here, folks. I'm telling you. Go ahead, Dave.
Why didn't gold go to 10,000 or higher during the 2008, 2009 financial crisis if it was the safe haven play?
I can't answer that. I can tell. I have an idea.
Okay, let's hear your idea.
Okay, why the price of gold didn't go up is that people, number one, there wasn't the demand. It starts at demand. There were people that did get into gold then, but a lot of people didn't. They went to cash. They went to other things.
I think there was a lot of buying of gold. I mean, when I was looking at forums and people who
I
were
don't.
talking about the financial crisis in 2008, 2009, everybody was saying, "Hey, buy gold." I bought gold. Buy gold. Buy gold. And gold did have a nice run,
Right.
but it didn't go to 10. I saw a lot of people predicting gold going to 10,000, especially because, hey, it is real money. The Fed is printing money. This is a hedge against inflation. This is a hedge against deflation. It's real money, and everybody recognizes it across the world as real money,
So
right?
if there was a tremendous demand, then why didn't it go up?
Central banks were selling it.
Ah,
The central banks had
now it's the
accumulated.
supply component comes into
Yes.
play. There was such an ample supply
Yeah.
that it not only met demand, it was teetering on exceeding demand.
That's right. Central banks did the same thing that they're doing now. They had accumulated large stockpiles of gold going into the 2008, 2009 recession.
Okay.
And when this recession came, in order to supply their own liquidity needs, they sold that gold into the market at the height of the recession, or the height of the financial crisis, supplying the demand by retail investors. Retail investors ended up holding the bag. And so that's why the price of gold eventually declined. They're doing the same thing now. Sovereigns are buying up lots of stockpiling gold again.
Right.
One fact that may have escaped a lot of our viewers is the fact that gold doesn't, just because, let's say a sovereign like Germany or Sweden has a stockpile of tons and tons of gold. When they sell it, they don't necessarily move that gold around. This is kind of an interesting little fact. People will buy it, and then they keep it where it is in the Swedish banks and vaults,
And pay them
and charge the buyers a
a carry
storage
fee. Right.
carry fee. That's exactly right.
Yeah.
So it's not like gold was like moving all over the place. The Swiss bank said, "Yeah, you can buy it. Oh, by the way, we'll store it for you. No problem. It's just a couple bucks a year."
Yeah, not a big deal.
So they're doing the same thing that they did back then. They've accumulated a large stockpile of gold. And at this point, we're waiting for the next recession in order to sell it into the demand that they know is coming from the retail and average investor.
Well, the demand, I mean, the market is telling us that demand is increasing because the last 5-6 months, gold has been on a nice
Upward
steady,
trend.
a nice
Absolutely.
steady track up, for sure, for sure.
Yep. But watch the
Interesting.
price of gold. At some point, if we're in the middle of a recessionary period now, within 6 months after that officially might end, well, officially based on the criteria that we're using here, when that ends, gold will probably decline once again.
Interesting. That leads me, well, I have a question.
Mm-hmm.
And folks, so before we started taping, I was asking Dave what he thought about the current state of the market, and I thought he'd be all bummed, and he wasn't. He says, "Hey, I've got a strategy that's working even in this environment." So what my financial literacy hasn't incorporated those elements yet, but there are people that are able to get rich and preserve capital in deflationary environments, in recessionary circumstances. Do you know any stories or things that you feel that you could share that wouldn't be specific financial advice for somebody, but things that other people have done?
As far as make money during a recession or deflation, or a
Or at least being able to
financial
preserve your
crisis?
capital.
Preserving capital, yeah, it's really important. So in the 2008, 2009 financial crisis, one of the things that was really apparent was the fact that when the Fed started printing money, that the dollars that I held in my bank account were going to be much less valuable. And so, one of the things I started thinking about was picking up very, very cheap stocks. So I knew that I knew that the amount of printing, the complete devaluation. Now, we talked about value very early, right?
Right.
And so what happened was, in almost every economic cycle, there's always this period in which it happened after the dot-com crash, it happened after the financial crisis in 2008, 2009, it's going to happen again. You're going to have a period in which assets, including financial assets like stocks, are going to go way below real intrinsic value. You're going to have bargains at that point. And I didn't like holding cash, but I wanted to wait for the ideal opportunity to pick up those assets at very, very cheap prices, in assets that pay me. So one of the issues that I looked at was I'll give you the symbol, it's CHI. It's a opportunity and income fund that paid a monthly dividend of about 15 cents per share at that time. And it had gone from approximately $15 down to like $5. It had gotten completely beat up, but it maintained its dividend of 15 cents a share. And so what happened to the yield, because the price of the issue had come down so much, the yield went to like 17%, very, very high. And I bought a ton of it. I just left it there. I didn't touch it for almost, I didn't touch it until last December, when they cut their dividend. A cut in the dividend to me is a big warning sign.
Sure. But what you were able to do was buy an undervalued asset, paying you an income to hold it, paying you your dividend. Now, let me ask you this. How long did it take for CHI to recover its $15 share price after you got it for $5? Because that's a capital appreciation position. Or did it ever recover?
It got to 14, but it didn't completely. It did not completely recapture that $15 level.
15. That's still pretty. For
pretty
you,
close.
$5. What an incredible capital appreciation perspective.
So that was icing on the cake. So
yeah, sure.
The money that I put in tripled in value without putting another dime into it, based on compounding interest. The compounding interest and the capital appreciation almost tripled. It wasn't quite triple, almost tripled the value of that investment over the last 15 years. Well, 12 years. Yeah, it's unbelievable. That was the value of capital appreciation.
And so let me throw in. Now I'm coming at you common sense kind of thing. So it would make sense to me that if markets are at an all-time high and I'm in the market, getting out before the alarm bells ring, right, would probably be a good idea. Get myself into something like a gold, and when the prices come down as a direct result of all, which happens in all recessions, valuations come down, that would be the time to deploy capital for these distressed assets.
That's one way to do it, because we're going to have distressed assets at some point in time. Here's a story I'll relate to you. I used to work and live in Boston, and there was a brokerage that I had an account with. And during my lunch hours, I worked in the financial district down in Boston. Uh-huh. And during my lunch hours, I'd go into the office, and there was this older gentleman there who was always there every single day. And he and I struck up a conversation one time, and he was looking at the tickers, and I said, "Hi, how are you?" He said, "Yeah, how you doing?" I asked him, "Have you been in the market long?" He said, "Yeah, all my life." Mm-hmm. And I said, "Oh, do you have a specific strategy that you could share with me?" Because at the time, this was back in early 90s. I was like 28 years old, and
Oh,
I
okay.
was a
You
young
didn't have a
guy.
computer or a cell phone in your pocket to
There was
look
no
at.
computer, no cell phone. I had to go into the brokerage office to look at
Oh,
the
okay, okay.
tickers to
Got
make
it. Got it.
quotes.
Like, what did you pull up to the brokerage in the covered wagon and then you jump out?
Covered. Yeah, just about.
Sorry, finish your story.
So we struck up a conversation, and I asked him what he did for a living. He said he sold flowers on street corners. So he had a corner in Boston, and he sold flowers, and he did it all year round. And his wife never worked. And he said, "Look, I'm like, he was like 80, and he goes, you know what? Just making, I made a living, and whatever cash I could afford, I just put it into the most beaten up stocks that I could possibly find." The ones that were just, the street just hated them. They beat them up. But I would do some research, and I found out that these companies were well managed. They had a good cash flow. Fundamentally, they were sound, but they were just out of favor. And so all he did was put like $100 a week into this one, a couple $100 into that one. And over a period of just 15 years, he said, the capital appreciation. Now, he didn't go for the dividends. He went for capital appreciation. And he amassed out of just 100, he was talking 100, 150, $200 a week at the most. He had accumulated a portfolio of over $3 million.
Wow.
Just
Well,
by
that
buying
really
these.
speaks to the value of compounding interest and capital appreciation.
Absolutely.
We've been talking about almost this whole series.
Absolutely. He
Yeah.
was not interested in a stock that was hitting new highs. He was interested in the stocks that were hitting new lows day after day after day, 90, 78, 80, 90% beaten up. But the fundamentals of the company were sound and the management was good. And so he picked up, talking about value investing, he picked up some of the shares of these stocks for very, 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 very inexpensively, and just rode them until sometimes he triple, quadruple, 10 bagger, 20 baggers on some of them. One of them, he hit 100 times his investment. And so it doesn't take too many of those. And he would sit on them for 6 months or a year or 2 years. Typically after 2 years, he said, if they haven't rebounded or they haven't recovered at least partial of their stock price, then he kind of gave up and put it into something else. But he did regular investments, only beaten up stocks with good fundamentals. And he just, he said he didn't put more than probably $100,000 of his money over the years, but he's accumulated.
To make that 3 million over 15. Wow. That's
exactly, and actually that's exactly how I feel about XRP right now.
Yeah,
it's been beaten up. Fundamentals are good. And hey, that is, and I practiced, actually, since he said that, I practiced that. I didn't understand it fully right away.
Sure.
But about 10, 15 years ago, I started doing that myself. Right? And not until I hit my 40s and, mid 40s. And I started doing that on a small basis, and it's just been absolutely fantastic. If you have time, and even not even if you have time, but if you have some basic understanding of a company's balance sheet, looking at the fundamentals, looking at the news, finding out why the stock was beaten up, and you look into the management. Look at the management of XRP, of the companies that support the ecosystem, like Ripple and SBI, Corda. All of these companies have fantastic management, and it's the exact same strategy.
I agree. I could not. Oh, bravo. So if I was to try to do like a recap and takeaway from this particular episode, understanding value, getting clear about what the terms inflation, deflation mean, hedging, getting myself into a position where I understand the environment that I'm in the moment, because obviously that's going to play a role in my decision making, right?
Right.
my purchasing power today versus tomorrow, what it was last week, those kind of factors come into play. Obviously, it's always a good idea to get out of debt, consumer debt. If you're in debt as a consumer, it's always a good idea to get yourself out. We talked about diversification. I will continue to work on that, even though all of my actions say that I'm fully diversified in the XRP token. I like every one of the zeros before the point and all of them after. So
Yeah. Exactly.
Diversification, and then preserving capital in this deflationary environment. Boy, that's a lot to chew on, Dave. I think we jammed a lot into this episode. What do you think?
Absolutely. Just to summarize,
Please do.
my personal portfolio is XRP, the beaten up stocks that we just talked about, okay,
Mm-hmm.
and then income from dividend stocks that pay me really, really well to hold them.
Sure.
Those three.
I'll share mine also. We went over my exit strategy and we talked about me using one of my bags, but my primary holding obviously is XRP. I hold some Bitcoin. I also have a brokerage account still. I'm not completely out of that game. And I'm in a couple of REITs that not only I felt had upside for capital valuation, but also pay a nice dividend.
Right.
Yeah. So,
and
folks,
here's something too, just to leave people with it, is that there's a bubble both in stocks and in bonds. Currently. As I mentioned earlier on, the 30-year Treasury bond right now is at 1.84%. Lowest level in 100 years. Traditionally, when the stock market starts to decline, people will put their money into bonds.
Right.
That may not be the case anymore because it is in a bubble. And if they do, and if it blows up, we start to see some interest rates that go higher, or it's just stagnant. I believe, and this is just my personal belief, that cryptocurrencies, and especially XRP, are the non-correlated asset class, the new non-correlated asset class to both bonds and stocks. And when Wall Street wakes up to that fact, and we do get legislation indicating and giving us clarity on cryptocurrencies, a lot of the money from the bond and the stock market will go into cryptocurrencies.
Well, if for no other reason than that principle you talked about, hedging.
Yes, exactly.
For no other reason.
For no other reason. Non-correlated asset, hedging, and potentially a safety play.
Okay.
For what it's worth.
I can't disagree with that at all. As a matter of fact, I think I put all my money on that particular thesis. They say put your money where your mouth is, right?
Yeah.
So, folks, on behalf of Dave and myself, thanks for hanging with us in this conversation. If you take nothing away from this, except for this point, and that is learn. Have the heart of a student. These things that we talked about aren't normal dinner conversation kind of things. Reach out to people that you see that are in these worlds. Do what I did. Become friends with somebody like Dave, who's got 40 years in this game. Get yourself educated, because the world can be a dangerous place. It doesn't have to be. And if we stick together and continue to grow and challenge each other, we all got pretty bright futures together. So on behalf of Cryptopolis and myself, we want to say thank you for joining us on Beyond Moon. And until next time, everybody, Pura Vida.
Bye, guys.